Welcome to the Deep Dive. We're here to sift through the sources you've given us, cut past the headlines, and hopefully give you some real clarity.
Yep. And today we're diving into Verizon, specifically their third quarter 2025 results. We've got the earnings report, the SEC filings.
Right. And the big tension here, the thing we need to figure out, comes straight from the top.
Yeah.
CEO Dan Schulman called this a critical inflection point.
He did. Said it required bold and fiscally responsible action. And he talked about aggressively transforming basically everything. Culture, costs, financial profile. Strong words.
Very strong. So for you listening, the mission today is pretty clear. Do these Q3 numbers actually show that bold transformation, or is it still mostly talk?
Okay, let's start with the big picture, the consolidated financials. And honestly, at first glance, they look pretty good.
How so?
Well, total operating revenue was up 1.5% compared to last year, landed at $33.8 billion. So, stable top line.
Okay, stable is good. But the excitement, the headlines were all about the bottom line, weren't they?
Oh, absolutely. GAAP earnings per share, the EPS number, they reported a jump of 50%. 50. Yeah, $1.17 per share this quarter compared to just 78 cents in Q3 last year.
And operating income?
Similar story, a huge leap. It went from about $5.9 billion in Q3 2024 up to over $8.1 billion this quarter.
Okay, hold on. A 50% jump in GAAP EPS.
Yeah.
That immediately makes you suspicious, right? Should investors be popping champagne, or is there something, hiding in those numbers?
That's the question, isn't it? When you see a number like GAAP EPS or operating income swing that wildly year over year, your first thought has to be, what changed? Were there one-off items?
So what was it? Let's unpack that huge jump. It sounds like maybe last year's numbers were artificially low.
Bingo. It really boils down to costs, specifically selling, general, and administrative expenses, SG&A.
Okay.
SG&A dropped massively, down over 20% compared to last year. Why? Because in Q3 of 2024, Verizon took a big hit, about $1.7 billion in severance charges.
Ah, severance.
Yeah.
From that voluntary separation program they did.
Exactly. They were cutting headcount, transforming the cost structure like the CEO talked about. They paid for it literally on the books in Q3 2024.
So that cost just didn't repeat this year.
Yeah.
And boom, operating income looks fantastic by comparison.
Precisely. The massive jump isn't really about Q3 2025 being stellar on its own. It's largely because Q3 2024 included those big one-time restructuring costs.
Which suggests that part of the CEO's statement, the aggressively transforming our cost structure bid, is kind of looking in the rearview mirror.
Right.
Like celebrating something they already did.
I think that's fair. And that's why, we always stress looking at the adjusted numbers.
Right. Adjusted EPS, what does that tell us?
It paints a much, much more modest picture. Adjusted EPS, which strips out those severance charges and other special items, came in at $1.21 for Q3 2025.
And last year?
It was $1.19.
Okay, so $1.19 to $1.21. That's barely any growth at all, 2 cents.
Exactly. So the underlying operational improvement year over year is pretty minimal once you adjust for those costs.
So if the big cost cleanup is mostly done, why the urgent critical inflection point language now? Does something in the current numbers suggest more pain, more bold action is needed immediately?
Well, I think there are two reasons for that framing. First, it's crucial messaging for investors. You need to show cost discipline is ongoing, not just a one-and-done thing.
Keep the pressure on.
Right. And second, I think it signals that while the bottom line is sort of stabilized, maybe artificially by those comparisons, the top-line growth engine, especially in their core business, might be sputtering. And that needs bold action, probably through investment and strategy shifts.
Okay, that makes sense. And that fragility, that sputtering engine, probably leads us straight to the biggest part of their business.
No.
The Verizon Consumer Group.
Yep, that's the main event. Drives almost, 77% of their operating revenue this quarter?
So how did consumer do? Is it really sputtering?
It's complicated. On the surface, the revenue looks okay. Total revenue for consumer was up almost 3% to $26.1 billion. And wireless service revenue, the really sticky stuff, that was up 2.4%.
So money's still coming in.
Yes, growth is there, driven by pricing changes and getting people onto different plans.
But I sense a but coming. Revenue growth doesn't mean much if your actual customer base is shrinking, especially those high-value customers. What happened with wireless phones?
And there's the rub. This is the weak spot.
Uh,
They are really struggling in the core postpaid phone market. In Q3 2025, Verizon reported a net loss of 7,000 wireless retail postpaid phone subscribers.
a loss? Wait, didn't they gain subscribers last year in Q3?
They did. They added 18,000 in Q3 2024. So going from adding 18,000 to losing 7,000,
Yeah.
that's a significant negative swing. They're actually contracting in that really critical high-value segment.
Ouch. And what about churn? Are people leaving more often?
Also not great news there. Wireless retail postpaid phone churn ticked up. It went from 0.83% last year to 0.91% this quarter.
0.83 to 0.91. It still sounds tiny, that fraction of a percent. Does it really matter?
Oh, it absolutely matters at Verizon's scale. Even a tiny increase in churn means significantly more customers are leaving. That forces them to spend more money just to keep the customers they have, and even more to try and attract new ones. It definitely squeezes margins.
So it confirms the market is still brutally competitive.
Fiercely competitive, yeah. Lots of promotions, lots of pressure.
Okay, so they lost postpaid phone customers, and slightly more are leaving. Yet consumer revenue increased. How are they pulling that off?
They're managing the customers they do keep very effectively. Average revenue per account, ARPA, went up 2%. It's now almost $148.
$148 per account, and how do they boost that?
The report points to two things: getting people to adopt more perks and premium MyPlan offerings, basically upselling existing customers, and also specific pricing actions.
So the customers who stay are paying more.
Essentially, yes.
Right.
It looks like they might be losing some of the more price-sensitive customers, but the loyal ones, maybe the ones on higher tier plans, are sticking around and spending more. That's keeping the overall revenue number afloat.
Interesting. A bit of a margin over volume play in the core wireless segment.
Seems that way, yeah. It's a tough balancing act in this market.
Are they completely abandoning volume, though? Any bright spots on subscriber numbers?
Well, there is the prepaid side. The core prepaid segment actually did okay. They added 47,000 net additions. That's the fifth quarter in a row they've seen positive growth there. So some traction at the lower end.
Okay, so prepaid is adding some, but the real star, the thing offsetting that postpaid phone weakness, seems to be broadband, right? Fixed connectivity.
It's absolutely. That's the clear growth engine within consumer right now. Total broadband connections. Up over 11% year over year. They're now over 13.2 million connections.
And that's Fios and the fixed wireless stuff.
Primarily, yes. Fios, their fiber product, had a great quarter. They added 61,000 Fios Internet customers net additions. That's their best result in 2 years for Fios Internet.
And fixed wireless access, FWA, using that C-band spectrum.
That continues to scale rapidly. They now have 5.4 million total FWA subscribers. So yeah, the focus on fixed connectivity, both fiber and wireless, is definitely paying off and propping up the consumer segment overall.
So it sounds less like an inflection point and maybe more like a pivot.
Yeah.
Shifting the focus from purely mobile to this broader connectivity play.
That's a good way to put it. The legacy wireless business is facing headwinds, and they're aggressively building this new fixed connectivity identity to compensate.
Okay, let's switch over to the other side of the house then. Verizon Business Group. Smaller segment, only about, what, 21% of revenue?
Roughly, yeah.
Yeah.
And it's facing its own pretty significant structural problems.
How did business perform overall?
Not great. Total operating revenues for the business segment decreased by 2.8% year over year, down to $7.1 billion.
Oof. Where's the pain coming from there?
It confirms that the traditional corporate and government connectivity markets are really shrinking. Enterprise and public sector revenue, down 6.4%.
What's a big drop?
It's the ongoing decline in things like traditional data lines, old school voice services. Companies are moving to newer tech. And the report specifically called out government efficiency efforts hitting their public sector sales.
So government belt tightening is hurting them. Any other weak spots?
Wholesale revenue also took a big dive, down almost 13%.
Wow. Okay. So the business side is definitely under pressure. That reinforces the need for that bold action the CEO mentioned, and maybe we see that action in their M&A activity.
I think that's exactly where you see the bold action manifesting. It's all about acquiring assets to bolster the areas where they do see growth, which, again, is fiber and fixed wireless.
What deals should we look at?
There are three key ones mentioned in the sources. First, there's the pending deal to buy Frontier Communications' parent.
Frontier, that's a big fiber player, right?
Exactly, pure fiber play. It's about rapidly expanding their fiber network footprint, especially in places where maybe they don't have FiOS or need to compete better against cable.
Okay, makes sense. What else?
Then there's an agreement to buy Starry Group Holdings.
Starry. They do fixed wireless, but focused on apartment buildings, right? MDUs.
That's right, multi-dwelling units. So that's a very targeted acquisition to get FWA technology quickly into dense urban areas, apartment complexes, places like that, subject to FCC approval, of course.
Gotcha. And wasn't there a Spectrum deal, too?
Yep. Back in August, they closed a deal to buy some Spectrum licenses from U.S. Cellular for about $1 billion. More airwaves, primarily for that fixed wireless build-out.
Okay, so if you connect the dots, Frontier for fiber scale, Starry for dense FWA, U.S. Cellular for more spectrum, the M&A strategy is crystal clear.
Absolutely. It's a very deliberate pivot. They're using acquisitions to aggressively build out these newer fiber and fixed wireless capabilities, likely trying to offset the slowdown or declines in traditional wireless and business services.
But that kind of M&A, plus building out C-band and FiOS, that takes serious cash. Do they have the financial firepower? Let's look at cash flow.
They do seem to. Cash flow from operating activities for the first 9 months of the year was up $1.5 billion compared to last year.
And free cash flow, that's the really crucial number for funding dividends, M&A, debt pay down.
Free cash flow also looks strong. $15.76 billion for the 9 months, up from about $14.5 billion last year. And importantly, they reaffirmed their full-year guidance.
What are they guiding for the full year FCF?
They expect free cash flow to land somewhere between $19.5 billion and $20.5 billion for the full year 2025. That's a lot of cash.
And where's that cash going besides M&A? Capital expenditures, I assume.
Yep. CapEx, including software they capitalize, was $12.3 billion so far this year. Big drivers are deploying that C-band spectrum crucial for 5G and FWA and expanding the FiOS fiber network.
Now, there was this one really specific item mentioned that sounds like it gave them a big boost. The One Big Beautiful Bill Act, OBBA.
Yes, OBBA. Sounds nice, doesn't it?
It does. It made 100% bonus depreciation permanent. Can you break that down? What is bonus depreciation, and why does making it permanent save Verizon like over $2 billion in taxes this year alone?
Right. It's a huge tax benefit, and it's super important for companies like Verizon that spend massively on capital equipment. Normally, when a company buys equipment like cell towers or fiber optic cable, they deduct the cost for tax purposes gradually over many years. That's depreciation.
Okay.
Bonus depreciation lets them deduct a larger chunk, or even 100% of that cost in the year they buy the equipment. So instead of small deductions spread out, they get one giant deduction immediately.
So all that spending on C-band and FiOS, they get to write off the entire cost against their income right away for tax purposes.
Under 100% bonus depreciation, yes. And the OBBBA making that permanent provides certainty. The impact for Verizon this year. They expect it to slash their 2025 cash income tax payments by $2.0 billion to $2.3 billion.
Wow. That's $2 billion they don't have to send to the IRS this year.
Exactly. That cash stays in their pocket, directly boosting free cash flow. It makes funding all that CapEx and M&A much, much easier. It's a massive non-operational tailwind for their cash position this year.
So that tax benefit, combined with not having those big severance payments from last year, really explains the strong cash flow picture.
It contributes significantly, yes. Underneath it all, the core operations still generate substantial cash, but these factors definitely provide a big boost.
And what about debt? They still have a mountain of it, right?
They do. About $146.8 billion in total debt. But the key thing is they reported they're in compliance with all their debt agreements, all the covenants. So despite the high level, the strong cash flow means they can manage it for now.
Okay, so let's try to wrap this all up. What's the final synthesis here?
Well, if we pull it all together, Verizon delivered strong bottom-line results in Q3. Things like operating income and GAAP EPS looked great. But a lot of that was driven by lapping last year's severance costs.
Right, the comparison was easy.
Exactly. And their cash flow is robust, definitely helped by that big OBBBA tax benefit this year. They're financially solid, they're meeting debt requirements, and they're absolutely deploying capital aggressively, especially through M&A, to build out fiber and fixed wireless. That part of the bold action is clear.
But there's always a but.
But the core engine, the main revenue driver, that consumer wireless postpaid phone segment, it's showing signs of strain. Net losses in phone subscribers, churn ticking up. That's a real headwind.
So for you listening, it's kind of two sides of a coin, isn't it? On one side, you've got solid financials, good cash generation, boosted by some temporary factors, and a clear strategic direction with their investments in fixed broadband. That looks pretty good.
Right. The fiscally responsible action seems to be happening, or at least the results look fiscally sound right now.
Oh. But on the other side, achieving that return to growth the CEO talks about, that really depends on turning around the slight decline in their most important market, core wireless phone customers. The fixed broadband growth is great. It's mitigating the damage, but they need to stabilize wireless loyalty too.
That's the operational challenge right there.
Which leaves us with a final thought for you to chew on. We see massive investment, both CapEx and M&A like Frontier and Starry, pouring into fiber and fixed wireless access. How long can that broadband growth keep carrying the consumer segment before they absolutely have to fix the churn and subscriber trends in the core mobile phone business? That feels like the key question going forward.